Before I start my podcast today, before I bring on my guests, I have a request. I hope this request sounds like a broken record. I would like you, the audience. I'm not asking for money. I guess I could. Maybe nobody would listen if I asked for money. All I want is your honest take. Go to iTunes. The easy URL, covel.com/iTunes, takes you right to iTunes, forwards you there. Write a review. Say I'm awful. Say I'm good. Say you enjoy the guests. Say you want more. Just say something. It helps the process. I'm going to keep this machine going. But I need your help. Now... This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Andrew Huszar. He's a senior fellow at Rutgers Business School, a former Morgan Stanley managing director. And in 2009, he managed the Federal Reserve's $1.25 trillion mortgage-backed security purchase program, QE1. The Fed brought Andrew in to make it happen. Interesting insights. Interesting perspective. I hope you enjoy. I read your piece last fall, and then probably like a lot of people, since the stock market kept going up, I forgot about it. And then today, in preparation to talk to you, of course, I've read it multiple times, and I've got it strewn out in front of me with red lines and dots and scribbles all across it. And it's just, I think the one emotion that hits me is, I want to say that I'm angry, but then I just say the thing is broken beyond repair. And I'm almost zen about it. I don't know. It's mind-boggling.
I think the point you made at the beginning is very important. I think given that we're at all-time highs in the market, right now everybody feels kind of that way, right? Where, okay, it seems like some people are just happy with where we are, but others are saying, especially those in the market, we are where we are. Things are going, who knows where things are going to go in the future. Let's just worry about the short term. Let's try to get through it. Let's hope maybe make some money off of it, or let's just, obviously trading volumes are really down. Let's just withdraw from the market. So I think there's sort of this moment of, it's kind of a little bit like where we were in 2005, 2006, 2007, right? Where people were talking about the housing market and what problems we were getting ourselves into, and yet things just kept on moving forward. And then there was this. I actually last night I listened to your Malden interview, and you guys were talking about the black swan idea and how these are sort of, these aren't unexpected. It's just the timing is always unpredictable, right? Of the ultimate breakout of whatever problems we end up having.
So let's go back in time. You're a Wall Street veteran. You've been at Morgan Stanley. Spring of 2009. I mean, most people in the markets, most people in America, around the world, basically thought the S&P, how low could it go? It felt like implosion time. And you, on Wall Street at the time, get a phone call from somebody at the Federal Reserve saying, hey, we need you. We need a trader. We're getting ready to start this massive stimulus project. Come help us.
Right. So just to give you, your narrative is mostly right, but let me just sort of correct a couple things. So I actually I did a JD MBA at Columbia. I graduated 2001, and from 2001 until 2007, I actually worked at the Federal Reserve, at the New York Fed. Basically what is the operational sort of command for the Federal Reserve. That's where the trading floor is. And I was a lawyer originally, then I was actually a regulator, and I had actually left the Fed at the end of 2007 because of a lot of frustration I had about Federal Reserve policy and basically what I believed was an excessive deference to Wall Street and believing that this was going to ultimately come home to roost. And lo and behold, in 2008, it happened. The crisis happened, and a lot of things that certainly I had no idea of what was in store or the magnitude of the crisis, but I had been really frustrated by where things had been, and I went to work actually on the trading floor of the Royal Bank of Scotland, basically the UK's Citibank, where I was a trade structurer. My Morgan Stanley tenure came later. And so I'm at RBS. I'm sitting in a cafeteria in Stamford, Connecticut, chewing on my lunch for about 10 minutes while we're trying to save the bank effectively. And I get the 2 a.m. call at about 12:30 p.m. And the call basically asks from a senior official at the New York Fed whether I would come in and manage a $1.25 trillion stimulus, the centerpiece of this new program called Quantitative Easing. And on some level, so in a matter of a few days, I had a number of conversations, and a lot of my frustration about where we had gotten prior to the crisis, a lot of the fears I had, suddenly I was hearing different things from people within the Fed about, listen, we've made a lot of misjudgments, and really this is a period where we can rectify a lot of sort of regulatory lapses we've had, and it just felt different. It felt as if there was going to be something new, and obviously there was a larger conversation about change going on in America. We can talk about this more, but there had been a huge growth of Wall Street over the course of 30 years in America. Wall Street had basically doubled in size and doubled in significance to the U.S. economy, and had become far more concentrated in terms of the big banks. And so I volunteered to go back to the Fed because I believed that this was the moment in which we were going to perhaps take some steps to right-size the size of Wall Street, and this stimulus program QE would hopefully be the last step in terms of helping to stabilize the situation so that there could be some more meaningful structural reform in the U.S. economy. And in my mind, that had to start with the idea of breaking up the big banks, basically the 6 big banks, which now controlled assets that were equivalent more or less to 60% of the size of the U.S. economy. And so that's where it all started.
87 banks back in the mid-1980s, down to 6.
Exactly. So in the span of basically 20 years, if you want to think about it, as you said, in 87 you had basically in mid 80s you had 87 banks controlling assets equivalent to 30% of the U.S. economy. By 2007, it was 6 banks controlling assets equivalent to 60% of the U.S. economy. So that Wall Street had become twice as big and 15 times as concentrated in the span of basically a generation. And so, there's a lot of underlying issues and factors that led to the financial crisis. But one of them was basically a Wall Street that became very anti-competitive, and I believe lost its way in terms of really what it was supposed to be doing, from going from being more of a credit intermediation function to really becoming a trading shop, one big trading shop. And again, we can talk about this more, but I'd argue, today it's gotten actually far worse than where it was even a few years ago.
Well, let me slide back in here for a second. So they call you up, they say, come back. You're going to buy $1.25 trillion in mortgage bonds.
Yeah, I'm like, how many zeros are there even in a trillion at this point?
Up until that point in time, the Fed in 100-year history has never bought one mortgage bond. So that's the history. So you're walking into this, though, and you write this in your op-ed piece. You say it was kind of a dream job. But was it a dream job in the sense that you figured this $1.25 trillion was going to be the final backstop? And that, because to me, it kind of because I read your article and I'm like, oh my gosh, this guy's just given this perspective that I wish everyone could understand. But it's interesting that you inserted yourself into the middle of it at that moment in time.
Yeah, I mean, my job basically when I got back to the Fed was to oversee a program in which we bought effectively 1/10 of the housing market in the span of 15 months. The reason I thought it was a dream job was two reasons. First of all, again, I had spent 7 years of my career at the Fed. I had a lot of close friends inside the institution. I have great respect for many people inside of it. There's a lot of smart, well-intentioned people there. I left out of frustration, and suddenly there was this opportunity to go back and really sort of see through the rest of my career. I thought I was going back for a longer period of time. Secondly, though, more importantly, I think, beyond the personal, I really did believe that the U.S. economy had grown in a very unsustainable and unbalanced way, and a lot of that had to do with the growth of credit. If you look at debt in the U.S., and obviously a lot of people focus on the government side, but just looking at the consumer had basically become 250% more indebted, the U.S. consumer, from 1998 until 2007. We had this huge ramp up in credit, a lot of which dovetailed with the end of Glass-Steagall and the changing of the banking model in the U.S. And so, to me it seemed as if, again, there was this opportunity to have more, to take a step back and really think about how we wanted the U.S. economy to evolve going forward. And in a very improbable way in my own mind, suddenly I was in a position where I could actually help. If you think about what the Fed had done, in 2008, the Fed had basically done a number of emergency facilities, about $1.5 trillion of emergency facilities to try to stabilize the banks in Wall Street. QE was the next step. The U.S. economy had become so reliant on credit during the course of the same period I just talked about, where when Wall Street basically got on fire, it really had a really negative knock-on impact to the U.S. economy. In the fourth quarter of 2008 alone, you had more than 2 million Americans lose their jobs, and the U.S. economy shrunk in the span of 1 quarter, 2%. And so suddenly the Fed was coming up with this program where it actually, before it called it quantitative easing, it called it credit easing. And the idea was to use bond purchases to try to lower the cost of credit, make credit more accessible to those Americans that needed it, to try to just get through the crisis. And so I thought this was a temporary stimulus program that was hopefully going to help stabilize the U.S. economy and really give space and time to the rest of the U.S. government to try to do some of the more meaningful structural reforms that were necessary.
Okay, but once you got to the show and once you find out what Oz is doing behind the curtain, it really had nothing to do with any of that. And as you say, the greatest backdoor Wall Street bailout of all time. Why don't you explain for the average person, and I think, for example, in the last couple of years when you hear that J.P. Morgan made money 65 out of 65 days, I think that's going to go to part of it. But why don't you explain why this QE policy that was positioned by the chairman of the Federal Reserve as a way to help Main Street, to lowering borrowing costs and all this other well-intentioned rhetoric, why don't you explain what really happened?
Well, so I will say, in defense of the Fed, I do believe that QE started off as a well-intentioned policy, and actually I could make the argument, and I still do in public, that QE1 actually had some benefits, because what it ultimately did was it helped deleverage the banking sector. The U.S. banking sector, was like a store that had too much inventory in terms of credit, and so the Fed took a bunch of credit off of Wall Street's hands and sort of stabilized the banking sector. Where I really have an issue is the fact that QE1 was basically $1.7 trillion of bond purchases. We have now seen QE go on and be over $5 trillion of bond purchases. So my real issue, and really where I became really disillusioned, and why I ultimately left the Fed at the beginning of 2011, was when QE2 started, and when it hadn't really worked and I'll talk briefly about how Wall Street benefited, but at a high level, Wall Street benefited, but the knock-on benefits to the U.S. economy, this, stabilizing the economy, getting credit into the hands of the average American, that really didn't happen. So, Wall Street really benefited. Main Street was left behind. And yet the Fed has kept on doing this program, and even today is still buying $45 billion of bonds a month. But just in terms of how Wall Street...
Let me interject one thing.
Sure.
Would it be a fair view for some out there in the audience to say, okay, Andrew, you're on the inside, you're helping out, you've got noble intentions, and then all of a sudden they say, oh, hold on, we're going to go to QE2. And all of a sudden you're kind of like, hey, that's not what I signed up for. This doesn't make any sense. But could somebody in the audience, many people out there say, well, hold on. This plan was set in motion all along, or they got a taste of QE really fast in the first couple of days, and they knew they were going to go down this path no matter what. I mean, to me, I think you can make an argument that somebody knew that this was going to go on for a lot longer than, quote, QE1.
So I think definitely you heard quotes from Fed officials saying that, one point, kind of like with the federal stimulus, right, and the Obama stimulus, people saying this isn't going to be enough, and we would have to do more for this to work. But, I mean, I having been inside the Fed during the most, stressful and intense days of the crisis, I'd argue that there wasn't that much foresight within the Fed officials' minds. I mean, I think what you've seen really is they were basically throwing stuff on the wall and seeing what stuck. And
that's comforting.
I'm sorry?
I said that's comforting.
Right. Well, I mean, let's go back and realize the level of. I mean, people thought the world, as we know it, was going to come to an end. That you would not even be able to go to an ATM, right? So there was this level of desperation, and on some level, the rest of the U.S. government wasn't able to move as quickly as the Fed, and the Fed had been coming up with all these programs, which were on some level had succeeded in stabilizing Wall Street. So I think what I'd argue has happened is actually not enough strategic thinking. So not enough in terms of looking forward and thinking about the end game, and more sort of tactical thinking. And I think if you look at the Fed, and the Fed has become far more transparent over the last few years. I think if you follow the dialogue within the Fed, what you see is almost 3 months by quarter thinking. It's almost becoming more like a publicly traded company where there's just a lot of short-term thinking that's leading to really long-term disastrous issues. And we can talk a bit more about that. But I mean, I'll give you an example. So my program, again, which was this idea of buying 1/10 of the U.S. housing market, in order to stimulate...
1/10. I mean, you almost...
1/10.
You have to stop for a second. 10%. A government institution in a supposedly capitalistic country is now going to buy 1/10 of the housing stock. And that doesn't cause anybody pause.
I know. It's amazing. I mean, just to add to that point, the Fed's balance sheet before 2008 had never gone above $800 billion. Today, the Fed balance sheet is at $4.5 trillion. So the Fed has become over 5 times bigger in the span of 6 years. And we don't really hear about that either, right? I mean, it's not really discussed. But sort of my program, sort of this idea of buying all these bonds so as to stimulate mortgages, from day one, which was basically the beginning of 2009, January, till the last day, which was the end of the first quarter of 2010, we actually saw a decrease in the amount of mortgage lending by Wall Street's banks in the span of 15 months. So despite this incredible, unprecedented program, which was called credit easing at the beginning, which is the idea of making credit cheaper and more accessible to the average American, it didn't work, right? And so this is my main issue.
Why should Wall Street take risk if the government's going to take it for them?
Yeah, and so you had asked earlier, by the way, how Wall Street made money. And so there's really 3 ways Wall Street's made money in doing this. First is the way the Fed works is it's actually going out. The way it works is really in the sort of in the funding markets. That's how it's trying to. It basically is lowering through QE. What it's doing is it's actually lowering the cost of funding for banks. So it's cheaper basically for banks to borrow money. And so what banks were doing in the housing market, for example, was they were actually starting to get cheaper and cheaper funding to be able to make mortgages. But having watched the mortgage market over the last few years, mortgage rates never really went below 3.5%. Even when the 10-year Treasury went down, to below 1.5%. So the spread for Wall Street's banks increased. They were able to actually make a lot more money off of lending. But actually, they weren't lending as much. Today, a bank like J.P. Morgan uses about half of its balance sheet for lending, whereas as late as the late 90s, it was over 90% of its balance sheet was being used for lending. What is it doing instead? Well, actually, it's still trading. The banks, Wall Street's banks since 2008, have done a lot of what a lot of Americans and traders have done, which is they've ridden this so-called reflation trade. The Fed has basically talked about the idea of stimulating financial markets, to create a so-called wealth effect, where suddenly the price of stocks would go up, bonds would go up, and hopefully houses would go up, and hopefully people would have more money in their pockets and spend it. Well, Wall Street has done the same trade. They've stepped in and if you look at a lot of the quarterly earnings of Wall Street banks, a lot of it is being driven by trading. And then the third way the banks have really benefited from QE is they've made massive commissions off of QE, because the Fed on the mortgage side is actually buying all of its bonds through the banks themselves. And so the banks make a commission each time the Fed actually buys any one of these bonds, and that adds up to hundreds of millions of dollars, which is actually, compared to the first two categories, which is really hundreds of billions of dollars, it's not that big a deal, but it still tastes a bit bad that Wall Street's banks are making money off of this trade.
Yeah, I think I might put a different descriptor than a little bit bad. Look, listen, I want everyone to make as much money as they possibly can. I'm a part of Wall Street in some tangential way, but I don't like the idea that certain groups, certain banks, perhaps even certain people are allowed to have these kind of incestuous crony capitalistic existences. They get, certain groups get certain bailouts. Look, if you're going to let a couple of the investment banks go under, they should have let all the investment banks go under. They're just big old hedge funds. And the other hedge funds out there in this world, they don't get bailouts. So except unless you're long-term capital management. So I think that's the frustrating part to me, is that, it's what is the foundation upon which everything that we see that can look positive in the press, what is the foundation upon which it's built? And I can't predict or tell you how. Maybe it's going to go this way for the rest of our life. We don't know. But for any thinking man out there, thinking woman out there, it feels precarious.
It does, and I would argue where we have to start, and I feel like we don't have this conversation, or at least we haven't had it now for a couple of years, and I do think we'll be having it again, unfortunately, in the future, is this idea of an overly financialized U.S. economy. Again, it goes back to the idea that Wall Street as a percentage of corporate profits in America in the 80s, again, was about 15%, and today it's over 30%. If you look at the 6 too-big-to-fail banks, right, which we all know the names of, they actually have grown 37% bigger since 2008 in America. And so I think that where we've really gone awry, and again, I am of the school, I'm a believer of the Fed, and I really do have a great deal of respect for many people inside of it, but I believe it's a loss of perspective in my mind, and I believe it's almost a cultural issue in terms of the way our economy became so reliant on Wall Street and the banks, excessively reliant, and when things went really bad in 2008, rather than take a step back and really have a meaningful discussion about where we've gotten to beyond the lip service. I think all we did was we had those sort of superficial discussions, and then basically the only solution we've been able to come up with is to try to put Humpty Dumpty back together again. And on some level, all these various programs, and QE unfortunately is at the center of it, what they've done is they're intended to make Wall Street whole again and sort of put the economy back together when I'd argue the underlying foundations of the economy are consistently getting weaker. For example, you look at infrastructure in America, which is not an exciting topic, but in 2001 we were second in the world in infrastructure. Today we're 15th. You look at technology, the quality of U.S. technology in terms of our grids and our preparedness. Again, in 2001 we were second in the world. Today we're 16th. You look at college graduates in America. In the late 70s we were first in the world in college graduates. Today we're somewhere in the 20s. So I think in some ways we just haven't really done the longer term, less sexy things that we need to do in terms of investing in our human capital and physical capital. And instead, it's a lot easier to try to get by on credit and reflate Wall Street and keep this financialized economy going. And I'm not suggesting we don't need to have banks and and trading shouldn't be a huge part of our economy. It's just about what is the right percentage and how much is it actually benefiting all of America to have a huge financial sector versus can we get banks back to making loans and really supporting entrepreneurialism and more sustainable ways of growth.
I think with that Fed balance sheet, I think we all know the answer until the next break happens, and who knows what policies will be invented then. I think one thing interesting that you did put forward in your op-ed piece last fall was you talked about QE killed the urgency for DC to act in a responsible way. And I'm paraphrasing a little, but I'm thinking to myself, as an observer of politics and growing up in the DC area, and I don't really care what side of the aisle one is on, but I would argue that the goal of a DC politician is not to do the right thing and not to have a sense of urgency. The only sense of urgency a DC politician has is, am I going to get reelected? And can I still sit in the chair? And so I think that's a really tough thing where we're having a very nice conversation about doing the right thing. And I don't know your politics and we've not discussed that, but I think most people can agree, I think, from different sides of the aisle to say, wow, the financialization of the American economy is a little bit off. The idea that we're bailing out banks posing as hedge funds is a little bit off. But the reality is both sides of the aisle, really, there's not this incentive. And look, if you take it a step further, the people in DC get elected by the people in the country, and the people in the country are going to be happy as long as the stock market is up. And to me, I ultimately come back to the position, and I'm not making a trading stance here or any kind of a prediction, but I think long-term structural changes in America, you really need that cathartic washout. You need that moment where people feel pressured and stressed in a way where there just can't be a bailout or a bunch of numbers or zeros added on in a government institution to make everything papered over and appear sound. And so I think there needs to be some pain at some point in time. And, I just think that that's where we're at. And I don't know how you feel about that.
I'm on the same page with you, so entirely. So I put out my op-ed basically the week that we had the hearings for Janet Yellen as the new Fed chair, because I thought that was a moment where hopefully I could make an impact on the conversation, and hopefully really we could have a conversation that we haven't been having about this program and really this central bank activism and how productive it really is for the economy. So I was in the gym the day after my op-ed, and one of my neighbors was there, and a retiree who hasn't been making any interest off of his investments for years now. And I said, what do you think? What do you think about and he follows the market. And I said, what do you think about Yellen? He said, well, I don't really know about her because I just don't follow the Fed that closely, but I really do hope she gets in because because my 401k really needs the help. And I think the point is a lot of Fed's policies explicitly have targeted the financial markets, especially post QE1, right, where the Fed kind of said, okay, this lending thing really isn't working, and let's really focus on a wealth effect, where we'll continue QE with the goal of really driving up the markets, and hopefully there'll be a trickle-down effect from things going up in value. People will feel richer, they'll spend more. So, to me, the biggest tragedy of that is the point you just made, which is the fact is we had this moment of pain. We had 2008. We had this unprecedented crisis. And on some level, I believe that this constant drumbeat of stimulus on some level over time, and the fact that we continued it, what it ultimately did was it reduced the urgency for change. And I think in that respect, financial markets serve a really valuable function in our society, and that is as a signal.
Price discovery.
Exactly. They really do. They're not efficient. I don't believe in the efficient market hypothesis, but ultimately they seem to get to the right place. And I think when you have this program which is targeting artificially pumping up markets over time, what you're really doing is reducing that urgency. So, for example, we let's remember TARP. TARP. Again, whether you like it or not, they put out TARP 1 and it failed, and the vote went down, and the market fell dramatically the next day. Well, lo and behold, 3 days later, TARP passed, right? Or I go back to last year when we had the government shutdown. The U.S. stock market went up during the government shutdown, and I'd argue a huge part of that was the fact that the Fed was out there buying bonds every day and pumping money, effectively pumping money into the U.S. stock market. So, that's my biggest fear. My biggest fear is we are at an all-time high, effectively, in the U.S. stock market and bond market, and yet we have an economy in which, if we had the same labor participation that we had pre-2008, we'd have over 10% inflation. We have a median American wage that has now fallen from an inflation-adjusted perspective back to where it was in 1989. I just talked a little bit before, and I could go on and on about all the underlying ways in which the fundamentals of the U.S. economy, the competitiveness of our economy globally is sinking. And yet, there's this huge amount of complacency out there. And I don't know, again, it's really hard to time the market. I can't really tell you when things are going to go bad, but the fundamentals and the longer term picture, it does not look good in terms of, I'd argue that the markets really aren't based on fundamentals. They're based on stimulus and a lot of great accounting tricks by a lot of companies.
It's all food for thought, Andrew. Hey, listen, where is the best place if people want to follow along? I don't know if you're blogging right now, if you're writing in other areas. Where can people follow along?
I do have a Twitter handle, and that Twitter handle is at Andrew Huszar, H-U-S as in Sam, Z as in zebra, A-R.
Well, I must say it's food for thought in the sense that if you want to imagine that everything is A-OK, and I would ask my 70-year-old mother this, if I told my mother, hey, did you know that the government bought 10% of the housing stock in America? Do you think that means the economy's okay? I know what her answer would be.
Yeah, it's really hard, right? It's common sense discussions are harder and harder, it seems. And it seems as if, from a media perspective, and you hear, Nicholas Kristof said something about how the media is really good at reporting new news. It's really not that great about reporting the same news over and over again. And it becomes a bit depressing to talk about the same things over and over again. But if we aren't talking about it and finding new ways to engage in the conversation, we're doomed to repeat history. And that's it sounds like you and I agree. That's potentially someplace where, unfortunately, we may be heading.
Yeah, that probably means it's time for me to go Google another picture of Kate Upton. Enough of this serious talk, right? Hey, listen, Andrew, it was good chatting. Hopefully we can talk again in the future.
Great. Thanks, Mike. I really appreciate it.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.